Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. Today, our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making. We have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that. I think a particular focus for us going now over the past 6-7 weeks now and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards? And is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. Again, I would just point out we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging. And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict. There were 3 large banks really from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress. Okay, I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward. So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time. But people did talk about pausing, but not so much at this meeting. You know, that there's a sense that we're much closer to the end of this than to the beginning. That, you know, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there.